Alright, I'm CM Onikroy and today we are here to discuss advanced capital budgeting of AFM. And like you people are very much aware, this chapter is a newly added one, and the chances of getting a direct questions from a newly added chapter is significantly high. So we can expect even the same this time. So we'll be dealing with this advanced capital budgeting right from scratch. In case you're a newbie, welcome mate, you're at the right place. I can assure you once we're done with this session, you'll be having a plethora of understanding on these concepts, and both from a both considering all these concepts and irrespective of a difficulty level on these chapter they say put in the exams, you still be able to tackle all this. And considering these notes, it even serves both that purpose. Firstly, the concepts one, you'll be getting a in-depth understanding of all the concepts, and then considering the examination perspective, I've even made a question specific points for you. In fact, I've seen all the questions and I've made these accordingly as well. So it covers both the concepts and this questions oriented thing as well. So in fact, we'll be dealing once we're done with this revision session on advanced capital budgeting, we'll be dealing all these questions itself. By all the question, I mean in fact, you people tell me what are the questions that you want me to discuss on this. So put the questions in the comment section so that we'll be our next session would be such a question solving. And then not just for AFM, we'll be doing the same for FR and for the DT as well. So let's start before we proceeding, let me make it very clear for you people what we'll be dealing with this within this chapter is there are two or more investment projects that will be given in the question, and we'll be asked to select the best of them with a view to maximize the shareholders' wealth. So that's what is given. Capital budgeting is a process of evaluating and selecting long-term investments that are consistent with the goal of the firm's shareholders' wealth maximization. It involves making decisions about investments in fixed asset capital projects, such as purchasing new machines, expanding production facilities, or launching a new product. All right. So again, NPV, like we've seen it a number of times. In fact, we've been seeing it for FR, right? So in NPV, like you people are aware, NPV is a PV of cash inflow minus PV of cash outflow. PV of cash outflow is initial investments. Now, at what rate should we use it to discount it? There are two types of discount rates. There are two types of discount rate: real and then nominal. Real is exclusion, nominal is inclusion of inflation. So if case one, if cash flows given are in real terms, like this is excluding debt, I mean excluding inflation, and this guy has in question this guy has given you a real interest rate. What you'll be doing, you'll be discounting these cash flows which are in real terms using a real interest rate. Let's say if cash flows given in question, but in the question instead of real, this guy has given you nominal interest rate. So you need to convert nominal into real interest rate and discount the cash flows which are in real terms using such converted real interest rate, or else you can convert these cash flows which are in real terms into cash flows in nominal terms and then discount such cash flows which are converted in nominal terms using a nominal interest rate. So how is that will be converting? In question there will be an inflation factor that would be given. So 1 plus nominal interest rate, since like we discussed nominal equals to real plus inflation rate, but we cannot just take NR equals to real plus inflation. Will be instead of it will be taking 1 plus nominal equals to 1 plus real interest rate into 1 plus inflation interest rate. So from this, nominal interest rate would be 1 plus real interest rate into 1 plus inflation rate minus 1. So now that you know, you can do it this way. Other cash flows which are given in real terms can be converted in nominal terms using inflation, or else convert the nominal rate into real rate using inflation by this way, right? So you see this FR classes DTFM. We are progressing. We are doing each and everything of all these subjects, right? So I wrote the same here. If cash flows are given in real terms, inflation is not inflating cash flows, then use real interest rate. And if the cash flows are given in nominal rate, that is inclusive of inflation, so use a nominal interest rate. 1 plus nominal equals to 1 plus real into 1 plus inflation. Nominal equals to 1 plus real into 1 plus inflation minus 1. This is what we exactly discussed. And now cash flows. If at all you people are aware of these, revenue minus variable cost equals to contribution minus fixed cost equals to EPIT, right? We had these and we have seen all these topics in the intermediate level itself now, but then here we'll be getting EBIT, but then now we'll be needing actual cash flows. For what? For the purpose of discounting and finding NPV. Now actual cash flows equals to revenue. These are all the costs, right? These and these. Revenue minus total cost. Let's say revenue is somewhere around 120 and total cost is somewhere around like 70. So then EBIT would be 50, right? Let's say this cost includes depreciation of rupee 10. This is case 1. Now from total revenue we reduce total cost, which is inclusive of depreciation of 10. So now we have got EBIT to 50. From these EBIT, let's say tax is 10. Example, let's say tax is 10. So we'll be getting 40. From EBIT, if it happens you to reduce tax, the remaining would be operating profit after tax. Operating profit after tax. PAT, operating profit after tax. But then, sir, it's EBIT minus interest. Then we'll be getting EBT minus tax. We'll be getting EAT. Why is it the interest not been reduced from here? For the fact reduction of interest. See, if at all you are these cash flows are particularly from a project, right? So how would these be impacted by interest? I mean, if at all you have borrowed some, like let's say you have borrowed 1 crore and invested in this machinery of 1 crore. So for the fact of you borrowing and investing and you incurring additional interest on that borrowing amount, impact the cash flow so being generated by the machine, no, right? The machine would still be giving us same cash flows irrespective of the way how you invested in it. So if you invested using your own money, the cash flows generated from the machine would still be the same. If you invested from a borrowed money, the cash flows from the machine would still be the same. So the cash flows generated from the machine would be nowhere impacted from the way how you borrowed it or how you invested it, right? You getting it? You in the way have you accumulated the amount required for the investment purpose does not affect the cash flow generated from such machine, from such project, right? And that's the purpose why we are not reducing interest. No minus interest concept. No minus interest concept. So we'll be getting operating profit after tax. And now this is a case 1. Case 1, depreciation of 10 rupee. So but then depreciation is not the actual cash flow. We'll be adding back a depreciation which is not actual cash flow to find actual cash flow. Now the actual cash flow is 50. What we did a same thing of this table which you used to do in intermediate. Revenue minus cost, total revenue minus total cost equals to EBIT. EBIT minus tax will be getting operating profit after tax, but we will not care should be given minus interest is not to be reduced. EBIT minus interest, there is no concept of minus interest. Why? The, like just we discussed, the cash flows generated from a machine is nowhere affected by the by how you purchased the machine, right? Simple. So there is no concept of minus interest. Directly EBIT minus interest, no minus interest. EBIT minus tax, operating profit after tax plus depreciation. Why? Because depreciation is not the actual cash flow. So here we'll be getting the actual cash flow. Now, if at all there are certain changes in, if at all there are further investments required, or like I mean to say, if there is an increase in working capital, if there is a decrease in working capital, if there is an increase in capital, that means the cash flow is outward. I mean, there is an outflow of cash flow. There is an outflow of cash flow. If cash flows are in, if there's an increase in working capital, that means cash outflow is increased. So minus, for example, if that is 10, and if there's a decrease in working capital, that means the cash flows from that machinery is no longer required. So we are taking back the cash flows. Let's say that that is 20. So here 50 minus 10, 40 plus 20, 60. Yeah, 60. And yeah, that's it. These are the actual cash flows. Now again, what we did revenue minus total cost. We got EBIT. From EBIT we reduced tax. We will not be reducing interest. We reduce tax. We got operating profit after tax. Since depreciation is not the actual cash flow, add back a depreciation, we'll be getting cash flow. But then these are not usually happen. But in fact, there is no question on the advanced capital budgeting in which this is included. But then I just made a point of noting this. In fact, there is a question. There is always a salvage value. So the salvage net of tax is also the cash flow. This would be from the cash flow of last year. This is a cash flow of last year. So I want you people to note this. Noting this itself is solving majority of a portion of the question. Rest of the things will be doing. We need to do is only finding out the NPV. All right. Once know this, that's it. If at all there is a salvage amount of 10 in last year, we'll be getting 70 of last year itself. For last year, salvage value will always be for last year, and we'll be taking net of tax. Case 1, if depreciation of 10 lakh is included in expense. What we did, we added back the depreciation amount here because this is not the actual cash flow. Now case 2, same, entirely same, but then the cost, in cost we have not taken depreciation of 10. That is, this is only 60. Case 2, 120 minus 60. We got 60 minus 10. Let assume this event to be a same. So 50. This was operating profit after tax. Now can we take entire depreciation of 10 because we have not included it in depreciation? I mean, since the depreciation is not excluded from the revenue, and the PAT, net operating profit after tax, arrived is exclusive of the depreciation expense. Can we add back the entire depreciation expense? No. Can we just leave it with 0? Even this is not possible because here also there is an actual cash outflow that is not happening. A cash outflow that is not happening is a tax saving. Tax on debt. Tax on debt. This much of tax we are saving. This much of tax we are saving. So this is a cash inflow. Sorry. Operating profit after tax plus depreciation into tax. 10 into, let's say that is somewhere around 30%. We got 53. Rest of the things are always the same. What we did, we have actually taken two cases. Case 1, case 2. Expense includes depreciation. Expense excludes depreciation. If expense is inclusive of depreciation, from operating profit after tax, we need to add back a depreciation to arrive at a cash flow. If expense is exclusive of depreciation, from operating profit after tax, we need to add back depreciation into tax rate to arrive at a cash flows. I hope we are clear. I wrote the same thing here. If expense includes a depreciation, if expense are exclusive of depreciation, I mean doesn't include depreciation. Sales minus total cost minus tax, we'll be getting NOPAT. From NOPAT, we need to add back depreciation. And then increase in working capital. Increase in working capital is actual cash outflow, so reduce. Decrease in working capital is actual cash inflow, so add. Here is a cash flow, the same here, but then here depreciation to tax rate. That's it. In fact, this would be helpful for you people to entirely mug this up, because by mug these up I mean for you to read it multiple times so that you get a format of these fixed in your brain, which will be useful for you to solve the questions at the earliest. And then comes expected NPV. Expected NPV, let's say for year, let's say in year one, there is a 0.1% chance. There is 0.1% chance for cash flow to be 10,000. Point like 0.5% for cash flow to be 50,000, and then 0.4% of chance for cash flow to be 40,000. What is an expected cash flow? What is the expected cash flow? Expected cash flow for 10,000 is 10,000 into 0.1. Similarly, expected cash flow plus 50,000 into zero point 0.5 plus 40,000 into zero point 0.4. We'll be getting this much of amount. This is expected cash flow. Expected cash flow. How is that we got it? Is sigma probability into cash flow. Alright. Now using these cash flow, find it for year one. Let's say this is for year one. Similarly for year two, there is 0.1, 0.8, 0.1, 50,000, 90,000, 1 lakh. So find the same way expected cash flow. So this is for year two. Expected cash flow for year two. We got expected cash flow for year one here. Find for year two. Now using this cash flow C1, C2, C3, year 1, year 2, year 3. We got all this, discount this with a PV. We'll be getting PV of cash inflow minus initial investment. We'll be getting expected NPV. I hope you understood. So how is expected? How is the expected NPV will be found? Is if the different cash flows are given for the project for the same year based on the probabilities, then for the NPV calculation, step 1, find expected cash flow probability into cash flow sigma. For step 2, find expected NPV based on step 1 cash flows, and then variance. Variance is a standard deviation square. Variance and standard deviation, both of which measures a risk. It explains how much the cash flows are. How see? Let's say our cash flows of year one is 30,000, for year two is 20,000, for year three is 30,000. So we'll be taking average of these cash flows. Let's say that to be somewhere around 15,000. So like we said, year one cash flow is 10, year two is 20, year three is 30. We'll be taking year one cash flow is 10. Now the average cash flow is 15. How much of these cash flow differs with the average of this cash flow? It measures a dispersion from the average. It measures a dispersion of cash flow from the average. Variance equals to standard deviation square equals to, it measures dispersion of the cash flows how much the cash flows differs from the average cash flow. This is what a standard deviation explains. So standard deviation variance explains. Variance is the standard deviation square. The formula would be sigma p into x minus x bar whole square under root. Standard deviation equals to variance equals to standard deviation square. Now p like probability, x is a cash flows for the year. Cash flow for the year. X bar is the mean, or else you can say since p is given, there would definitely be or else we can take it this way. X bar equals to expected cash flow. How will you be arriving at this? Is sigma p into cash flows. For example, year 1, year Alright, let's take a same example. Year 1, these are the cash flows. What is X bar here? Let's say this into this plus this into this plus this into this is somewhere around 15,000. This is X bar. These are X. How will you be arriving at variance for year 1? Variance for year 1 equals to X minus X bar whole square. How will you be doing this? X, what is X? 10,000 minus X bar. Here it is 15,000. X minus X bar whole square into probability 0.1. This plus 50 for 50,000. 50,000 minus 15 X minus X bar whole square into probability plus same for year 3. How much is this? 40,000 minus 15,000 whole square X minus X bar whole square into probability. This plus this will be arriving at this plus this plus this. Let's say this is somewhere around 20,000. This is our range. Alright, will be not arriving at 20,000. Let's say this is somewhere around like 20. That would be variance. Right. Now we got variance for year 1. We just found out the variance for year 1. But now what is accumulative variance for year 1 plus year 2 plus year 3? Let's say the variance for year 1, year 2, year 3 are, let's write it here. We got just by using the above formula, we got variance for year 1. Let's say that to be somewhere around 20. Let's say for year 2 that is 30, for year 3 that is 40. Let's say for example. Now what is a variance, cumulative variance for all the cash for all these years, for all years? This is called Hiller's model. Cash flows greater than 1 year, finding variance for the cash flows greater than 1 year. Finding variance for cash flows greater than 1 year. Now there are two type of cash flows. Firstly, the cash flows are independent, and then the cash flows are dependent. How will we be knowing if at all the cash flows are dependent or independent? In question, if there is nothing specifically mentioned, you assume that to be cash flow. You assume a cash flows to be fully independent. If in question specifically given the cash flows are dependent, only that would be a time when you have to use a formula of fully dependent cash flows, finding over rates, right? So if the cash flows are fully independent, that would be variance for year 1 by 1 plus discount rate or interest rate into whole power 2 plus variance for year 2 by 1 plus interest rate whole power, here 2 into 1, here 2 into 2, that is 4, plus variance for year 3 by 1 plus interest rate into here 2 into 1, here 2 into 2, here 2 into 3, that is 6. 1 plus interest rate whole power 6. If the cash flows are fully independent, what is independent, what is dependent? Just give me a sec. We'll be discussing that too. Now, if at all the cash flows are fully dependent, then variance for year 1 by 1 plus interest rate whole power 1. Here these and these would be the same. Now variance for year 2 by 1 plus interest whole power 2 plus variance for year 3 by 1 plus interest whole power 3. So if in case the cash flows are fully independent, then variance for year 1 by 1 plus interest whole power 2 into 1, like variance for year 1 by 1 plus interest whole power 2, variance for year 2 by 1 plus interest whole power 4, here 2, here 4, plus variance for year 3 by 1 plus interest whole power 6. So here 2, 4, whole power 2, whole power 4, whole power 6, whole power 8, so on. 2 into 1, 2 into 2, 2 into 3, 2 into 4, 2 into 5, and so on. When the cash flows are fully independent. Provided the cash flows are fully dependent, variance for year 1 by 1 plus interest rate for year 1, variance for year 2 by 1 plus interest rate for year 2, variance for year 3 by 1 plus year interest whole power 3 for year 3, plus so on. Now, what is dependent cash flows? Independent cash flows. All right. Let's say if this let's say this is a financial year 24 20 23 24. Now you have turnover, you have approached a bank for a all right. Let's say for financial year 23 24, you approach it bank in financial 23 25, approach a bank for raising a loan, or let's say a CED, CC. Now bank the loan would be provided at the rate, let's say 30 percentage of 23 24 turnover. Now consider this. Let's say the turnover of 23 24 is 10 crore. In 24 25, loan of 30 percentage of 10 crore will be provided, and in 25 26, loan of 20 percentage of 10 crore would be provided. In 26 27, loan of 40 percentage of 10 crore will be provided, or else let's make 30 50 60, this way would be provided. Now the cash flows for 24 25 are completely dependent on the turnover of 23 24. Now the cash flows for 26 24 are also completely dependent on turnover of 23 24. Like also for 26 27, the cash flows are completely dependent on 23 24. If it is 60 crore, the amount here would be different. If it is 90 crore, the amount here would be different. If it is only 1 crore, then the amount here would be different. So this is a case of the cash flows being fully dependent. If the cash flows are not fully dependent, then the cash flows are independent. So if in the question, unless until specifically given the cash flows are fully dependent, you assume that to be cash flows are independent fully. And since the cash flows are fully independent, whole part 2 into 1, whole part 2 into 2, whole part 2 into 3. The formula we have taken here, this formula is for year 1, is for a single year. But if the cash flows single year, but these to find variance for cash flows greater than 1 year using Hiller model. Are we clear till now? I want you people to go through it. We are done. Alright then. Once see this, I've written the same thing even here. Variance equals to standard deviation square. Standard deviation equals to sigma p probability index minus 6 bar whole square. X should be a cash flow. 6 bar would be the expected cash flows. This is in fact a mean. So the variance and standard deviation measures it is a dispersion of how the cash flows differs from the average of the cash flow. That is the mean expected cash flows, probability into cash flows. P equals to probability. Now the project with higher variance will be not selected. Now we'll be selecting a project with a lower variance. Once under Hiller model, when the cash flows are of more than 1 year, if cash flows are fully independent, then first variance by 1 plus interest whole part 2 into 1, second year by 1 plus interest whole part 2 into 2, plus third year by 1 plus interest whole part 2 into 3. If cash flows are fully dependent, first year variance by 1 plus interest whole part 1, second year by 1 plus interest whole part 2, third year by 1 plus interest whole part 3. So let's see the next concept, that is a coefficient of variation. Coefficient of variation is a standard deviation by x bar. Uh, since we cannot measure two different projects of different cash flow, let's say there is a project A of cash flows 10 lakh of cash flows in lakhs, and there is a project B of cash flows in crores. We cannot find a standard deviation of cash flows which are in lakhs and cash of a project of cash flows which are in lakhs and project of cash flows which are in crores, and we cannot measure these cash flows and select the project with these huge variation in the cash flows. So for this purpose, we found the method of coefficient of variation, return which measures risk per unit of return. Per unit of return. These being a risk, these being a return. So coefficient of variation measures risk per unit of return. So that now let our cash flows of a project in lakhs and the cash flows of a project in crores can easily be compared using a coefficient of variation, which earlier with the standard deviation would be not possible, because the standard deviation, like how can you compare the cash flows which are in lakhs and the cash flows which are in crores using a standard deviation? Not at all a reliable measure of we finding out and finding out the best alternative. So now let's look at the notes. While standard deviation is used to compare risk associated with the different projects, but standard deviation will not help to compare risk of different projects with the different cash flows. Hence, a coefficient of variation concept is used in this case. Now, coefficient of variation calculates the risk borne by every unit of return from a particular investment. This enables comparison of the projects with a different cash flows. Coefficient of variation equals to standard deviation by expected cash flows, or x bar, or expected return. Expected cash flows again probability into cash flows, x bar that's a mean. Now risk adjusted discount rate. Risk adjusted discount rate. Let's say there is a project. Sorry. Let's say there is a project A and B. Now investment in both of these is 100. But then these, let's say let's measure risk on a scale of 8 to 10, I mean 1 to 10. Here it has a risk of 8, here is it has a risk of 6, and the return, now which of the projects should you accept? Now considering everything same, we'll be accepting the project with a lower risk. But then if it happened me to select to accept a risk, to accept the project with a higher risk rate, what should be my return? What should be the return? I mean, at which risk, at which rate of return will I be willing to accept the project of higher risk? That is a concept of risk adjusted discount rate. Now this is a risk. Firstly, we'll take risk free rate plus risk premium. This is in fact similar to CAPM. How we'll be doing it? CAPM, RF plus beta into RM minus RF, right? RA here exactly same, but then it is RF plus, instead of beta we'll be taking risk index into RM minus RF, right? So RADR, if the risk associated with the investment project is higher than the risk in a similar investment project, then the discounted rate is adjusted upward to compensate the additional risk borne. So it is a rate at which I'll be willing to accept the project of higher risk. But then this much of return I'll be needing. So RADR equals to RF risk free rate plus a risk premium. How is that this amount be calculated? It is a risk index into minimum return minus RF. In CAPM, RF plus beta into RM minus RF. Okay. There in CAPM, RM in CAPM, RM was market return, but in RAD, alright. In CAPM, RM is a market return, but in RADR, RM is a minimum return, right? Now certainty equivalent approach. Certainty equivalent approach, sensitivity analysis, equivalent annual cost, optimum replacement cycle. Question specific note, replace now later, should replace or not. decision tree analysis. Alright, we are done. We will be done soon. Moment. Certainty equivalent approach. It converts risky future cash flows into equivalent certain cash flows, at which decision maker would be indifferent between uncertain risk cash flows and then the riskless or the low risk certain equivalent cash flows. Let's say if in a project it is 100% certain. All right, let's make it this way. There is a project A. Year 1 cash flow, year 2 cash flow, year 3 cash flow, 10,000, 20,000, 30,000. In fact, all the cash flows that as on 0th year we make, or all the cash flows that we will be given in the question, are pure estimation. There is no 100% guarantee that this much of amount will be received. All right. So what if this is for company A. What if there is a company B which offers company A for a certain cash flows, or else let's say there is an there's a company B which offers company A for certain cash flows in exchange of some contract or some consideration, in exchange of some random consideration. If this company B offers, there is at least 90% of this amount will be given of year 1, at least 80% of this amount will be given in year 2, at least 70% of this amount will be given year 3. That means if cash flows are 12,000, there is no need for this guy to be given anything. So if a cash flows are, let's say, 1,000, but then there is 90% certainty that 9,000 will be received. Likewise, there's 80% certainty that 16,000 will be received. There is a 21,000. There's a 21,000. 70% certainty that 21,000 will be 70% certainty, which is 21,000. So this much of amount would definitely be received. This we call as certainly equivalent cash flows. Certainly equivalent cash flows. If at all the cash flows fall below this 10,000, 20,000, 30,000, there is a company B which has given a certain which has entered into contract of a certainty to provide this much of cash flows. Here we have no relevance for this. I just take it to explain to you this way, but this is not how it works. Just to give you a random understanding of how the concept of certainty equivalent, I just explained this way. So here there is a certainty equivalent. Now these are mere expectations, mere expected cash flows, but then there is certainly equivalent cash flows. So I mean, there is 9,000 below which there is no chance of you receiving cash flows of below 9,000. At least 9,000 you will be receiving, at least 16,000 you will be receiving, at least 20,000 you will be receiving. So this is what called a certainty equivalent cash flows. C coefficient will always be given in the question. How will you find a cash flow? C into cash flows. So you will be finding certainty equivalent cash flows. All right. So find certainty equivalent cash flows and then find NPV using that. And okay. C always lies between 0 and 1. CE of 0 means cash flows will be not received. Cash flows 1 means no adjustment required. No adjustment required. C of 0 means cash flows are of no use. Let's say the cash flows are 100 and there is a certainly equivalent coefficient of 0. That means there is 0% chance that amount of 100 will be received. So the cash flows are 0. Let's say here the cash here there's one, CE coefficient is 1. That means there is 100% chance that 100 will be received. So the CE cash flows are 100. C always lies between 0 and 1. C of 0 means cash flows is effectively worthless. So there is no value of these cash flows that it holds. Possibility of receiving those cash flows is 0. C of 1 means a cash flows is riskless, no adjustment needed. Now sensitivity analysis. Sensitivity analysis. This table we have seen, sales minus variable cost will be a contribution. Contribution minus fixed cost would be, just a minute. Excuse me. Now, sale minus variable cost would be a contribution. Contribution minus fixed cost, net cash inflow. From this net cash inflow, you need to reduce our PV initial investment to arrive at NPV. This, in fact, you can take this to be what we discussed earlier, net operating profit after tax. But then in sensitivity, doing all this, you'll be arriving at cash flow, net cash inflow. So PV of a net cash inflow minus initial investment, also called a PV of a cash outflow, you'll be arriving at NPV. But for this, in the sensitivity analysis thing, there is no need for you to make all these to arrive at a cash flows. There's no need to make all this to arrive at a cash flow, because in the questions are merely based on these. So in the question, this sales and variable cost will be given, fixed cost at times should be given. That's it. There is no depreciation again. There's no salvage. There's no any other adjustments of working capital and so on. So you need to considering only sensitivity analysis. Learning this much should be sufficient. So sales minus variable cost would be contribution. Contribution minus fixed cost would be net cash inflow. Sales minus variable cost contribution minus fixed cost net cash inflow minus PV of cash outflow. You'll be arriving at NPV. I've mentioned the same thing here. Usually, sensitivity analysis question does not test on finding cash flows. Therefore, use above format as it is. Types of questions. Find NPV if the variable change by 10%. Let's say sales minus variable cost, contribution minus fixed cost, PV cash inflow minus PV of cash outflow, NPV 100, 20, 80, again 20, 60. Then this guy has given this to be somewhere around, let's say 40. So NPV would be 20, right? Now, types of questions. Firstly, if we call all this to be variables, all these are variables. If let's say if variable cost increase by 10%, what is NPV? So what you need to do, again make a same thing, sales and variable cost, contribution minus fixed cost, cash inflow, and there is no need to make PV for this again unless otherwise specifically given, because most of these questions would be like there is no concept of doing PV for the less than 1 year, right? So sales and variable cost, contribution minus fixed cost, PV of cash inflow minus PV of cash outflow. Question 1, if variable cost increased by 10%, what is NPV? This is 100. If variable cost increased by 10%, earlier it was 20, now 22. Again, now 78 minus 20, rest everything would be same. 60 here, that would be 58, 40, 18. Now what is NPV? New NPV is 18. earlier it was 20. Now how much by variable cost increased by 10%, what is the change in NPV that has occurred? By what percent NPV has changed? Percentage by which NPV changed is new NPV minus earlier NPV by earlier NPV into 100. What was a new? What is a new? 18 minus 20 by 20 into 100. That is like, I don't know, find that percentage minus that percentage. So this is the first type of question that would be asked. Find NPV if the variable. Yeah. Firstly, find NPV if the variable fixed contribution changed by 10%. So for this, you need to prepare NPV table and reduce a given variable by 10% and find NPV. By what percentage should the variable change for the NPV to become 0? Example cost. Okay, for this even I've put all the example for you. By what percentage should the variable change for the NPV to become 0? By what percentage should the cost change for the NPV to become 0? So let's say cost be x. So at NPV 0, the cost must be x. So at x, PV of cash inflow equals to PV of cash outflow. So now find x value from NPV table by placing all the given cash flows and given values and x in the NPV table. So percentage change in variable equals to PV, new variable minus old value by old value into 100. You got it? You understood nothing? Considering the same thing, now these guys asking by what percentage should, now let's say the variable be variable cost. By what percentage should variable cost change for NPV to become 0? This is second type of question. What was the first type of question? If variable cost increased by 10%, what is NPV? If variable cost increased by some percent or decreased by some percentage, what is the impact? First type of question, what is a change in one variable on NPV? Second type of question, how much of these variables should be changed for the NPV to become 0? Right? Now, by what percentage should should the variable cost change for the NPV to become 0? Let's say new cost be x. At x, NPV equals to 0. That is PV of cash inflow equals to PV of cash outflow. Let's take a same example. So what sales minus variable cost? Sales minus variable cost, contribution minus fixed cost, cash inflow minus PV of cash outflow, initial investment. Sales are 100. Let's say variable cost is x. Now the contribution would be 100 minus x. Variable cost, what was it earlier? 20. Now PV of cash inflow equals to 100 minus x minus 20. PV of cash outflow 40. So solve this. You'll be getting 100 minus x minus 20 equals to 40. From this, 80 minus x equals to 40. So x equals to 120. 100 minus x minus 20, 100 minus 80 minus x equals to 40. Alright, so x equals to 40. Check 100 minus 40 minus 60. That would be 40. 40 minus 40 would be 0. So second type of question, by what percent, okay, I've written it, by what percentage should the variable cost, should the variable or the variable cost change for the NPV to become 0? So the new variable, take a new variable as x and put the same format and take the new variable as x. So now solve this. 100 minus x minus 20 at this x, P of cash inflow equals to P of cash outflow. So these amount minus this amount equals to 0, or else this amount equals to this amount. P of cash inflow equals to P of cash outflow. From this you will be getting a PV, the new variable value. Now percentage of change of such variable. Percentage of change of such variable shall be new variable minus earlier variable by earlier variable into 100. That is, what is a new variable? 40. Earlier it was 20. 40 new minus earlier by earlier into 100. So this is some percentage. This is the answer. Question number 1. By what percentage would the NPV be? Question number 1. By what percentage shall the NPV be changed by the because of a change in a because of a percentage change of a variable? Question number 1. Question number 2. By what percentage should the variable change for the NPV to become 0? And then we can also make it this way. There are also alternative formulas for these question number 2 for type 2 questions, like by what percentage should the variable change for the NPV to become 0. Let's say if the variable is selling price, then use NPV by PV of sales. If a variable is unit cost, use NPV by variable cost PV. If the variable is sales volume, use NPV by variable of contribution. If it is initial investment, use NPV by initial investment. But then if it is a project lifetime, sales minus cost, sales volume. If in case of a contribution, for sales volume, use contribution. Investment, use investment. Project lifetime. For project lifetime, there are 5 steps that I have given in total. Firstly, find PV of a last year cash flow. Consider that to be A. Find a difference between NPV and A. So now let's say that to be B. Now B by A into 360 or 365 days equals to C days. Now new lifetime equals to existing years minus 1 into 360, 365 plus C days. Now the percentage change in lifetime equals to new lifetime minus old lifetime by old lifetime into 100. I understood, you understood nothing. There was this question, let me search for it. What else came a minute? There is a this is question number XYZ limited. XYZ limited. This is the same question, or it is not? Yeah. See this. XYZ Limited is considering a project for which the following estimates are available: initial cost, selling price, cost, sales volume for year 1 to 3. You are required to measure the sensitivity of a project in relation to each of the following parameters: sale price, unit, sales volume, initial cost outflow, project lifetime. You are required to measure sensitivity of the project in relation to each of the following parameters. So you can either, for this, you can either use this. You can either find using this, or this, or using all this stuff. These one, sale price, unit cost, sales volume, initial investment, project lifetime. For project lifetime, we will be doing anyways. So for sale price, use NPV by PV of sales. For sale price, use NPV by PV of sales. How will you find NPV? Firstly, sales minus variable cost, right? That was question number 9, right? So first and foremost, you need to find NPV. How will you be finding NPV? Sales minus contribution equals to variable cost. Alright, sales minus cost is contribution. Contribution is 20. 20 into 20,000, 20 into 30,000, 20 into 30,000. 20 into 20,000, 20 into, or else, just give me a minute. I'll make you solve this question because this is important, by the way. And in my expectation, there is a majority of chances of the sensitivity analysis directly appearing in this question. Firstly, sales. So find NPV, sales minus cost contribution, 60 40 20 into 20,000 first year plus 20 into 30,000 units second year, 20 into 30,000 units third year. What is the discount rate given? 10 percentage. 1 by 10 by 100 whole power 1, 1 by 10 by 100 whole power 2, 1 by 10 by 100 whole power 3. This is PV of cash inflow. So total of this would be 13 13 10 13 10 293 13 10 293 PV of cash inflow minus PV of cash outflow given 10 lakh. So NPV is 310,293. NPV 310,293. 310,293. Firstly, what did we say? NPV by PV of sales. So find PV of sales. What is the PV of sales? 60 into 20,000 units for first year. 1 by, I mean, okay, 1.1 whole power 1 plus 60 into 30,000 units second year, 1.1 whole power 2 plus 60 into 30,000 units for third year, 1.1 whole power 3. 60 into, okay, there is no, alright, let's calculate this amount. This is 39,3710. NPV. What was the NPV earlier? It is 310,293 NPV by PV of sales. 39,3710. How much is this? How much? 7.9 percentage. 7.9 percentage. So we got it, 7.9 percentage. Let's check with this allocation. 7.9 percentage. This is alternative method, but considering the original method, how we did, type 2 question. This is type 2 question. Original method, type 2 question. What was the type 2? By what percentage shall, here the variable is sales price. Sale price change for NPV to become 0. So it is sales minus variable cost, or else sales minus cost. Sales we don't know, let's that be X, and variable cost that is 40, right? Now minus 40 into 20,000 units for first year by 1.1 whole power 1. This, why we did this minus this into this is actual cash flow. This is actual cash flow. Why? Sales minus cost, contribution minus minus a fixed cost, again PV of cash inflow. But then sales minus total cost equals to PV of cash inflow. Sales, we don't know, we shall take that to be x, minus cost, that is 40. So PV of cash inflow, sales minus cost into units. This is for year 1. For year 1, take a same for year 2 into 30,000, year 2, and for year 3 too. Now x minus 40 into 30,000 for year 3. This is these are cash flow. We need to take PV of cash flow, right? So by first year cash flow, first year PV, x minus 40 into 30,000 by 1.1 whole part 2 for second year cash flow, PV of second year cash flow into 30,000 by 1.1 whole part 3. This is for PV of third year cash flow. All of this PV of cash inflow. We'll be taking PV of cash inflow equals to PV of cash outflow. We discussed this. PV of cash outflow equals to 10,000 initial investment or PV of cash outflow. So upon solving this, you'll be getting x somewhere around so 10,000, 10 one got stuck. 10,000 equals to 20,000. We took this to be x. Here this guy has taken s. We took that to be s. All right. So here it is 10,000 10 lakh equals to, we did the same, 10 lakh equals to x minus 40 into 20,000 by first year PV, like s minus 40 into 20,000 by first year PV, the same by 1 point whole part 2 whole part 3 second third year PV. So solving this, x is 55.26, 55.26. So by what percentage should that be changed in percentage for NPV to become 0? What was this? New minus earlier by earlier into 100. What is a new one? 55.26, and earlier that was 60. By 60 into 100, you'd be getting the same 7.9. What was it? 7.9. Yeah, 7.9 percentage. So either this method could be used or this method, but then solving using this method would take so much of time, right? So you can use this method, but then up to you. Here we did NPV by PV of sales. In fact, this was way too pretty and simple for us, right? So do the same thing we did for sales here. So do the same for unit cost. Take a cost to be here. Here we took this sales as x. Here for in case B, take 40 to be, I mean replace 40 as x, and then here sales volume. Sales volume. In case of sales volume, we will be doing NPV by PV of contribution, and then for initial outflow, same NPV by PV of the initial outflow, and then project lifetime. Yeah, we'll be discussing project lifetime. Project lifetime. Firstly, find steps. Project lifetime. At times, I myself get a pity seeing the handwriting of mine, but I'm sure I'll improve over a period of time. finding this to be no cause. Right, project lifetime. Project lifetime would be step one. Once we're done with this, we'll go read the steps as well, so that we'll be getting better understanding on this. Step one would be find last year cash flows PV. What is your last year cash flow PV? 30,000 into 20. 30,000 into 20 by 1.1 whole power 3. How much is this? 30,000 by 20 1.1 whole power 3. Okay, it is 450 600. We're done with step 1. Step 2. Since we found last year cash flow, now difference between last year cash flow PV minus NPV. What is last year cash flow PV? It is 450 600 minus NPV. It was 390 310 293. 310 293. How much is this? 140. This is the difference. Yet again, step 1, find a last year cash flows PV. Step 2, find a let this be A. Now find a difference between last year cash flow and NPV. Let this be B. And then step 3. Alright. Total days in last year. Is it 360 or 365? 360 or 365? 360 or 365? Since nothing being given in the equation, we take that to be 360 for the calculation to be simple. We'll take 360. So for me to earn, this is T, to earn 450 600, to earn 450 600, that would be taking 360 days. So how many of the days would that take for me to earn the amount B? For amount A, I would be taking 360 days. So how many days would that be taking for me to earn amount B? So that would be 112. Cross multiplication by 450 600 into 360. 112 days. So if I take 360 days for 450 600, I would be taking 112 days to earn 140 307. So now in total, earlier days, 360 into 3. How much is 360 into 3, brother? 1080. 1080. Now this is earlier. Now this is new. Now it is 360 into 2. First year 360, second year 360. And in last year, I would be taking only 112 days. So that would be 832 days. 832 days. This is earlier. This is now. So now by what percentage would that? By what percentage should project? What percent should the project lifetime change for the NPV to become 0? Change for NPV to become 0. What will we be doing all this time? We'll be taking NPV new, the new variable minus earlier by earlier into 100. That is 832 minus 1080 by 1080 into 100. That is 22.96 percentage. 96 percentage. Let's check with this. 22.96 percentage. All right, 97. Here we got 96.01 percentage change. Would that matter? No, not at all. All right, so leave all these calculations. You will not be understanding all these things. Leave all this, leave all this, leave all this, and I want you to copy this question. I mean, answer this question. In fact, not now. We'll once see with these concept notes, and then for every other thing, for sale price, we'll be taking NPV by PV of sale. For unit cost, we'll be taking NPV by PV of variable cost. For sales volume, here K should be taken. Here it is PV of contribution. For initial investment, we'll be taking NPV by PV of initial investment. For the project lifetime, we'll be taking the following. Step 1 would be find a last year cash flow, PV of the last year cash flow. Step 1, find a PV of last year cash flow. Step 2, uh, again, step 1, find a last year cash flow PV. Step 2, now the difference between, alright, wait. First find out the NPV. Step 1, find the last year cash flow. Step 2, a difference between the last year cash flow and NPV. The last year cash flow, let that be A. The difference between last year cash flow and NPV, let that be B. Now B by A into 360. Or else it would take me 360 days for earning a PV of last year cash flow. It would take me 360 days for earning PV of last year cash flow. How many of days would that be taking for me? It would be taking 360 days for me to earn PV of last year cash flow. How many of days would that be taking for me to earn a difference of PV of cash flow and NPV? Difference of PV of cash flow and NPV. PV of cash flow and NPV. Right? Step 1, find a PV of last year cash flow. Step 2, find a difference of PV of last year cash flow and NPV. Step 3, find the number of days. It would take me 360 days for earning a PV of last year cash flow. How many of that days would that be taking for me to earn a difference of a PV of cash flow of last year and NPV, the difference of this? So that would be C days. Now project lifetime equals to existing year minus 1 into 360 plus C days. Existing year, there are 3 years in total. Existing years 3 minus 1, 2 years into 360 plus C days. And then step 5 would be difference new lifetime and sold lifetime into 100. Right. Once we'll discuss here, and I want you to make a note of this. Step 1, again, first find last year cash flow, PV of the last year cash flow. Step 1. Step 2, find a difference between NPV and the PV of last year cash flow. That amount, let that amount be B. Now the difference between it would take me 360 days for earning a step A. I mean, for earning A amount. How many of days would that be taking for me to earn B amount? That would be C number of days. Now for the new lifetime, we'll be taking in minus 1 years into 360 plus C days. So that would be new number of days of a project lifetime. New number of days of project lifetime minus earlier number of days of project lifetime by the earlier number of days of project lifetime into 100 would be the change by that percentage. The NPV must be by that percent. The project lifetime must be changed for the NPV to become 0. That would be 22.96%. And I want you people to make note of this, because when I say material, you'll not be able to understand the things on this. All right, just make a note of it. And don't get me wrong, using not glasses, because I'm not used to it. I'm just used to doing through this. Or else you can take a screenshot. You can take a screenshot of it by pausing. I hope you're done. Let's check the remaining things. In fact, majority of the things are done. Now equivalent annual cost. Equivalent annual cost. Equivalent annual cost. In some like there is a project A, project B. Okay, we'll just see it this way. Equivalent annual cost equals to PV of the cash outflow by PVF. PV of a cash outflow by PVF. To compare the actual cost of two projects or assets with a different lifespan, PV of actual cash flow is divided by a PVF to arrive at the equivalent cash cost under both the projects for each year. Select the project with a lower EAC. Equivalent annual cost. equivalent annual cost equivalent annual cost would be PV of actual cash outflow by PVAF. Care must be taken. These would be used in case of a project with different lifespan. Different lifespan. Frequent annual cost is the PV of actual cash outflow by PVAF. You will be PV of actual cash outflow by PVAF. You will be okay. In fact, we'll be getting much more detailed knowledge on this once we are done with the optimum replacement cycle concepts and things. Optimum replacement cycle. Let's say if there is a machine which involves regular replacement, then at in which year shall that replacement be taken for the net cash outflow to be minimum? That's what the optimum replacement cycle helps us in understanding. This is the question that we got in May 24. So majority chances of few people getting directly the sensitivity analysis is high this time, in my opinion, though. All right, let's solve optimum replacement cycle. Let's solve with this example. A machine must be replaced at least every 4 years. Cost incurred to run the machine according to age is 15% discount rate given. So PV, like the PF discount rate for 4 years was also being given. Now purchase price, maintenance cost, repairs, and scrap value. How shall we see it directly from here, because I've already solved here, or else you want me to make it again, or else I'll make it again. So there is this purchase price 60,000, maintenance cost 16,000 for year zero, that is 0th year. Now the purchase price, there is a machine which must be replaced at least 4 years. Cost incurred to run the machine according to the ages as follows. Discount rate is also 15%. Now there are 4 years. Now optimum replacement cycle helps us in deciding which year, in year 1 or year 2 or year 3 or year 4 is the machine to be replaced for the cost to be minimum, for the cash flow to be minimum. So how is that we'll be finding it? Firstly, let's say if we replaced in year 0, I mean in year 1, if replaced in year 1, so the actual cash outflow would be cash outflow. What is the cash outflow? Maintenance cost. In year 1, I'll be needing to incur 16,000 maintenance cost anyways. So year 1 16,000 outflow, 16,000 maintenance into for 1 year it is discount is 0.8696, and then there is no outflow again. There is 32,000 inflow. 32,000 inflow. This is scrap into 0.8696, and then there is a purchase cost of 60,000 I must incur on 0th year itself. What are we doing? Let's say this is 0th year, this is 1st year, this is 2nd year, this is 3rd year, this is 4th year. There are outflows. Outflows being repairs plus maintenance. In 0th year it is nil. In 1st year it is 16,000. In 2nd year it is 22,000, 18 plus 4. In 3rd year that is 28,000, 20 plus 8. And in 4th year it is 36,000. This has given us all the cash outflows and also the cash inflows. What is the cash inflow? Being a scrap. In year 1 it is 32,000. In fact this is outflow, outflow, outflow. Or else let's make it here itself. Let's solve this question. Let's search with scrap. Yeah, this question. Question number 26. Let's do question number 26. It deals with the optimum replacement cycle. Optimum replacement cycle. Yeah. So in year 0, if it is replaced in year 1, you have to incur maintenance of 16,000. If replaced in year 2, you have to incur year 1 maintenance plus year 2 maintenance, also year 2 repairs. If it is replaced in year 3, you must have to incur year 1 maintenance, year 2 maintenance, year 3 maintenance plus year 2 repair, year 3 repair. If it is replaced in 4th year, all these prior year repairs and maintenance have to be incurred, right? So what in fact we are doing here is, let's make it this way. If that be year 0, year 1, year 2, year 3, year 4. Outflow, inflow being scrap, outflow being repairs and maintenance. So what's here it is 1632, outflow is 16,000, here it is 32,000, it is 20 to 24, 22 is outflow, 24 is inflow, and 16 is inflow. Sorry. 16 is inflow, 28 is outflow for year 3, 36 is outflow, 36 is outflow, and 8,000 is inflow. 8,000 is inflow. So now the optimum replacement cycle, we need to find in which year the cash outflow would be minimum. So for this reason, we need to discount it to year 0 using PV of year 1, first year. So discount second year cash flow, bring all this cash flow to year 0, PV of second year. Bring all the cash flows of year 3 to first year by using PV of third year. Bring all the cash flows of fourth year to 0th year using PV of fourth year. By this, all the cash flows of year 1, year 2, year 3, year 4 will be brought to year 0. Thereafter, what will we be doing is, we'll be taking equivalent annual cost. Equivalent annual cost at year 0 of, alright, cash flow of year 1 will be bringing to year 0, and find equivalent annual cost of such cash flow which were brought to year 0. All the cash flows of year 2 will be discounted and will be brought to year 0, and thereafter find the equivalent annual cost of such cash flows of year 2 discounted and brought to year 0. Thereafter thereafter bring all the cash flows of year 3 to 0th year and find equivalent annual cost, and the same discount the cash flows of year 4 to 0th year and find the EAC, equivalent annual cost of year 4. So find equivalent annual cost of all this years and select, and least of equivalent annual cost would be selected. Year of least of equivalent annual cost would be selected as optimum replacement cycle. Now you get me? So if replaced in, let's say if I replace that in year 1, then what is the year 1 cash outflow? Repairs, maintenance, and then repairs, maintenance, and then scrap inflow. Purchase price. This purchase price would always be discounted with 1 because this is of 0th year cash flow. So 0th year cash flow, therefore into 1 always, right? First year it is 16,000, scrap is 32,000 into year 1 cash flow 0.8, year 1 PV 0.8696, and purchase price of this machine is minus 60,000 into 1. Add all of this by PVAF 10 percentage 1 year 0.8696, because PVF is the PV of year 1 plus PV of year 2 plus so on. Now for PVF for first year would be PV of year 1 itself, right? Now this one into this plus this one into this would be 53182 by 0.8696. By 0.869646. Okay, sorry, this is not the amount. I just done the wrong thing. It is 46086 by 0.8696 would be 52,997 for year 1. Now similarly for year 2, repairs and maintenance, for year 2 we'll be taking year 1 repairs and maintenance plus year 2 repairs and maintenance. So for year 1 repairs and maintenance, discount it using year 1, year 2, year 2. I'll write it for you to make it simpler. Right. So firstly, year 1 maintenance minus 16,000 would be year 1 PV 0.8696. In year 2, we are taking repairs and maintenance of year 1 which have anyways to be incurred, and we are discounting it using first year PV, and maintenance there is nil. Or else repairs maintenance year 2. What is year 2 repairs? 18,000 and 4,000. This should be for year 2. What is year 2 PV? 0.7561, 0.7561, 0.7561, and then scrap of year 2. How much is it? 24,000 into 0.7561, and then purchase price minus 60,000 into 1 always. So what we did, we took repairs and maintenance of year 1 and discounted it using first year PV. We took repairs and maintenance of year 2, discounted it using year 2 PV. First year, second year. So all of these would be 44,536 in total. 0.8696, 0.7561, 0.7561. So equivalent annual cost would be 44536 by PVAF 10 percentage 2 years. That is 0.8696 plus 0.7561. That is 0.6257. So we got 40. Actually, this is not DPF. EAC equals to the total of all this is 72,402. 72,402 total of all this is. So EAC is 44,536. And similarly for year 3 and year 4. Again, for year 3, it is repairs and maintenance 16,000 into 0.8696. Year 1, 18,000 into 0.7561. Year 2, 0.7561. Year 2. And for year 3, it is 20 plus 8, 28. 28 into what is the PV of year 3? 0.6575. 0.6575 year 3, and scrap, it is 16,000. 16,000 into 0.6575 into year 3. Now we got we have taken represent maintenance of year 1 into PV of a first year, and then for year 2 and year 3 we did the same way, and lastly we taken scrap of year 3. Now total of all this would be somewhere around 98438. Find equivalent annual cost. That would be 98438 by PVAF, 10 percentage, and 3 years. That would be somewhere around 43114. So I want you to do a same thing for year 4 as well. That would be somewhere around we'll take directly EAC. That would be 43772. Now considering all the EAC for year 1, 2, 3 and 4. For year 1 it was 52997. For second year that was 44536. 43114, 43772. Now in which year is it lowest? It is lowest in year 3. In year 3 it is 43114. Therefore the optimum replacement cycle is year 4. I hope you understood. Again, I'll be telling you exactly at a glimpse. So what we did, this guy was asking us to find optimum replacement cycle considering a machine which could be replaced in any of the 4 years, in any of the first 4 years. So we have taken all the cash outflows of year 1, year 2, year 3, year 4, and also the scrap inflow. And we discounted first year cash flow using first year PV, second year cash flow using second year PV, third year and fourth year using a PV of those years. Of these years. And then we have found EAC, equivalent annual cost of each of the total cost of each of such 4 years, and then we have selected that year in which equivalent annual cost is minimum. So equivalent annual cost is minimum in year 3, and I want you people to make a note of it. So I put the same in steps for you. Step 1, find net cash flow for each year end. In fact, this is not that required, but just that for presentation purpose I made a step. Step 2, discount the cash flows to 0th year and add a purchase price and find EAC, equivalent annual cost. So we did all this. If repairs in year 1, company should incur repairs and maintenance in the first year, and scrap will be released in year 2. Realized in year 2. Therefore, the discount these amounts at the rate first year PV 0.8696 and bring to 0th year. Add the purchase cost of new machine. This will give a PV of the total cost in 0th year. Now find EAC. That is repairs and maintenance of first year, 16,000 negative. I mean minus 16,000 outflow into PV of first year. Scrap 32,000 into PV of that scrap first year. Then purchase cost first year, that would always be 1, always be 1 since PV of 0th year is 1. Then find EAC, you'll be getting 52,907. Similarly for second year end, EAC is 44,536. For third year end, what's EAC? That's 43114. And for fourth year, that's 43772, mate. So replace in the year in which EAC is list. We got that done in year 3. Now question specific note. If in a a question specific note, if in addition to new machine cost, if its annual maintenance cost and salaries are after useful life is also given, then find new machines PV, find EAC, do same calculations of optimum replacement cycle as above, but in cash flow consider the step 1 EAC as each year's cash flow and PV accordingly. So please read this. Serious note. Make note of this. This is question number 26, right? 26, yeah. Autumn replacement cycle, question number 26. Beating the drum like damn the detail, I can tell you rhythm you play. You done? Step 1 is only for presentation purpose, so no relevance does it carry. You can just ignore it if you people intend to. Step 2, in fact this diagram is very important. It's not that important, but then I made it for your understanding purpose. And if at all you draw this prior to you starting a question, that would give you a glimpse of what you'll be doing, and there would be a least possibility of you making mistakes. So it was on the 3rd of December. The sky shoes that they heard. Oh, fade away from the kitchen to the bathroom, smoking. Skips the don't put me down, try out. The situation on some money. Have you people noted? And this is a question specific point. I don't know which question, but just give me a second. I'll find which question is it. Yeah. So this note is considering this question number 2. In question number 2, this guy has given the salvage value and request cost and request 10,000 and which identified. Yeah, salvage value of the new mission has also been given. So if in addition to new mission cost, it's annual maintenance and salvage value, both of these for the new mission was given. Here it says 10,000 replacement cost 90,000, request maintenance of 10,000 will be required for each year for 8 years, and 20,000 of salvage will also be given. So if in the if such is a question, then find new machines PV of cash flow, like PV of cash outflow. How will you be doing this? 90,000 plus PV of 10,000 for 8 years, or else just let me. Question number 22. Find PV of cash outflow of new machine. Step 1. How's that you'll be doing? 90,000 cost, 90,000 plus maintenance. How much is it? 10,000. 10,000 into PVAF. How many years? 8 years. PVF 15 percentage 8 years minus scrap salvage. You'll be receiving how much? 20,000 into PVF your PV 15 percentage 8th year. So net of that amount would be 128,335. So step 1, find EAC of this. EAC would be 128,335 by PVAF 15 percentage 8 years would be 28,600. So we did a step 1. In step 2, like just how we were doing all this, like say repairs and maintenance into first year PV minus scrap into first year PV plus purchase price into 0th year PV, that is 1. Also add these 28,600 into first year PV. So in year 1 take this, in year 2 take this, into second year PV, year 3 take this, irrespective of the years. These consider these to be the actual cash outflow, alright, for each year. So I explain the same here. Question specific note. If in addition to new machine cost, its annual maintenance and salvage after useful life is also given, then step 1, find new machines PV of actual cash outflow and find EAC. Do the same calculate. Okay. I was wondering why this C suddenly came in here. No, what's the problem with this OneNote is it's getting stuck really quick. I don't know what to do. See, again, it got stuck. Let's take an eraser here. If at all it's listening to me, hey mate, please do come. Alright, I'll leave it. So if in addition to a new machine cost, its annual maintenance cost and salvage after useful life is also given, then find new machines PV of cash flow and find EAC. Just now we found, we have taken new machine purchase cost plus PV of maintenance minus salvage PV of 8th year. So we we are at a cost by PVF of 8 years would be equivalent annual cost. So do take equivalent annual cost, do a same calculations of optimum replacement cycle as above, but in actual cash outflow also consider the step 1 equivalent annual cost as each year's cash outflow and the PV accordingly. Now replace now or later. So look at this example. In case of existing machine cash flow, year 1 inflow nil, year 0 inflow nil, year 1 40,000, year 2 40,000, salvage 80,000, 70,000. New replacement machine cost 1.5 lakh, annual cash outflow 80,000 for 3 years. Should the company replace now or wait a year? That means, so find PV now, find actual cash flow now and actual cash flow after 1 year, and then whichever is lower, that would be the replacement. That would be better for you to replace. So step 1, find NPV of new machine. NPV of new machine would be 1.5 plus PVF 80,000 3 years at the rate 10%. We found now we got a new NPV 40,800. Now NPV if replaced now, NPV if replaced after 1 year. If NPV if replaced now, NPV of new machine 40,880 into first year plus NRV salvage 0th year. Replace nominal cells, replace in 0th year or replace after 1 year. So if I replace now, what is the cash flows? I must incur this. Right. So if replace now in 0th year, replaced now in 0th year or replaced after 1 year, that means in first year. So NPV of a new machine, we found 48,800 into 0th year NPV. 0th year PV is 1, and then NRV of 0th year 80,000 into PV factor 1, and NPV of 0th year we found 48,880, and then there is no cash inflow. Now if replaced in year 1, then cash inflow 40,000 into PV plus 70,000 salvage into PV plus NPV 48,880. So here it is 144, here it is 128. Now NPV is higher in replacement after 1 year, replace after 1 year. You got it? This is also a question. I don't know which question, but then this is the same example of ICI material. I mean, this is a question I've taken it and put it as an example. That's it. Company Y. Company Y. Sorry, I was searching it here. These were supposed to be company Y. Where are you, mate? How will that understand with the question being much different? Question number 25. So, expected is a cash inflow 40,000 in coming year, 40,000 next year. That means in year 1 it's 40, in year 2 it is 40,000. Then current salvage 80,000, 0th year salvage 80, next year salvage, year 1 salvage 70. Machine replaced with a new machine would cost 1.5 plus much more efficient will provide a cash inflow of 80,000 for 3 years. So I've taken NPV. Again, I'm explaining you for you. So now replacement machine 1.5 plus annual cash inflow 80,000 PVF, inflow minus outflow, new PV, new NPV. So NPV if done, if replaced in 0th year, NPV if replaced after 1 year. So NPV is more if replaced after 1 year. So select replacement after 1 year. Now should replace it or not? How many more concepts? That's it. Right? Should replace or not? If the firstly, if that should be replaced or not would be solely dependent upon the incremental NPV. If the incremental NPV is positive, then that would be beneficial for you to replace, and if it is not, do not replace. What is incremental NPV? Incremental NPV is incremental PV of cash inflow minus incremental PV of cash outflow. Incremental PV of cash inflow. Incremental PV of cash inflow equals to incremental cash inflow into PVF plus salvage of new mission into PVF. Incremental PV of cash inflow. What is incremental PV of cash inflow? Yet again, I'm telling you, incremental PV of cash inflow, incremental PV of cash inflow plus salvage, salvage PV, incremental PV of cash, incremental cash inflow plus salvage of new mission into PVF, here PV. What is our incremental cash inflow? Incremental cash inflow, there are two cases. Firstly, only revenue and cost are given, or else directly PAT is given. If directly PAT is given, then increase in PAT plus increase in depreciation. If directly PAT is given, increase in PAT plus increase in depreciation. If directly PAT is given, increase in PAT plus increase in depreciation. But then if revenue and cost is given, so what is an additional cash flow you'll be incurring, you'll be enjoying because of you investing in this machine? So that much of in question that would be given, a revenue would increase by 10% or the cost would be decreased by 10%. So take increase in revenue minus increase in cost net of tax. Increase in revenue minus increase in cost net of tax plus depreciation, increase in depreciation into tax. Care should be taken here, increase in depreciation into tax, but here it is not, it is just increase in depreciation. So if revenue and costs are given, if directly PAT is given, if directly PAT is given, take an increase in PAT plus increase in depreciation. If revenue and cost is given, take increase in revenue minus increase in cost net of tax, increase in revenue minus increase in cost, 1 minus t, and then add back increase in revenue into tax rate. But here it is tax rate, here it is no tax rate. Now increase in depreciation, present depreciation minus new mission depreciation would be increase in depreciation. So this is a PV of incremental PV of cash inflow equals to incremental cash flow plus salvage of new mission. We'll be getting a incremental PV of cash inflow. Now incremental PV of cash outflow, incremental PV of cash outflow would be market value of new machine minus market value of old machine. Market value of new machine we are supposed to purchase, that is a cash outflow, minus market value of old machine, like that is inflow. Market value of new machine outflow minus market value of old machine inflow minus tax saved plus tax paid. Tax paid inflow plus tax paid outward. Tax market, see what we are doing here is we are finding actual cash outflow. So firstly market value of new, or else I'll incremental cash outflow, market value of new machine. Let's say I have existing machine carrying amount 50, new machine cost 80. So market value of new machine 80 minus market value of old or existing whatsoever machine, that is 50. We are finding cash outflow. So this is cash outflow paid. We are, if we are purchasing new machine, we'll be even selling the existing machine, right? So here this is cash inflow received. Since we are finding outflow, we are reducing the inflow. Tax paid. Tax paid is actual outflow. Paid outflow. So add plus tax saved. Tax saved would be inflow. So saved, we cannot make that to be received, so we'll be saying that to be saved. Now tax paid or tax saved, how will you be calculating tax paid saved? Let's say carrying amount book value is 50. I've sold it for I've, I've taken the figures here, I suppose. Just give me a second. Let's look at the example. Oh, I didn't take. I've sold for 80. So this means you have got a gain, like market value exceeds carrying amount, so gain tax paid. How much is the tax paid? Market minus carrying into rate. 80 minus 50, let's say that to be 30%. So 30 into 39 tax paid. So carrying amount, if carrying amount is greater than market value is a sold, sale rate sold. So carrying amount greater than market value, that means I sold it at loss. Therefore this is tax saved. Tax saved rate into difference amount of carrying amount market and carrying amount. If carrying amount is less than a market value, then that is gain. So you have to pay tax on it. Difference into rate, right? So that's it. We have discussed even this. So yet again, should replace it or not? Should replace it or not? Replace it or not? That would be solely dependent on incremental NPV. Incremental NPV would be incremental P of cash inflow minus incremental P, or else. Just give me a second. I'll make it this way for you. Here we learned this is incremental cash outflow. Now incremental cash inflow. If directly PAT is given or revenue minus revenue and cost details are given. If directly PAT is given, then increase in PAT plus increase in debt. If revenue and cost is given, take increase in revenue minus cost to 1 minus tax, net of tax, plus increase in debt plus increase in debt into tax rate. Here must be okay, here it is into tax rate, but then here it is not. Alright, this is incremental cash inflow. We just have seen incremental cash outflow. Now the difference between both of these would be giving incremental cash inflow. So PV of that incremental cash inflow plus salvage. PV of incremental cash flow, PV plus salvage. This is PVAF, like 10 percentage, let's say for 8 years. Salvage PV 10 percentage 8th year, right? Minus outflow. This is PV of inflow minus PV of outflow, incremental. If positive, accept, negative, do not accept. That's it. We're done even with this. Let's fall in love. Let's love like a center. Now incremental NPV equals to incremental PV of cash inflow minus incremental PV of cash outflow. We're done even with this. Now the only thing that remains is decision tree analysis, decision tree analysis, decision tree analysis. This is again a question. LR limited, LNR limited. See, this is an illustration. Even this is important. LNR limited wishes to develop a new virus cleaner software. The cost of a pilot project would be 2.4 lakh. Present the chances of a product being successfully launched on a commercial scale at a rate of 50%. In case it doesn't succeed, it can invest a sum of. See how good of me. I mean, I'm even making you solve all the questions. Illustration 21. Sorry, it's 11. Majority of things have been solved here. So there is a new virus cleaner software that LNR Limited wishes to develop. The cost of a pilot project will be 2.4 lakh. Presently, chances of a product being successfully launched on commercial scale are 50%. Okay. In case it doesn't succeed, LR can invest a sum of 20 lakh to market a product. Such an effort can be generate perpetually an annual net cash inflow after tax. Right. An actual net tax cash income of 4 lakh. Even if commercial launch fails, they can make investment of smaller amounts of 12 lakh with hope of gaining perpetually sum of 1 lakh. Evaluate a proposal adopting a decision tree analysis. Decision tree analysis, there's only this simple question. So there is no concept of decision tree other than for the purpose of solving a question. That would be sufficient for you to just solve this question itself. And all right. So now, okay. If invest, don't invest. If invested, again there is a 50% probability of it being successful. How much it fish? Okay, for invest, I mean invest test 2.4 lakh. If don't invest, nil. And then for success, it is 50% probability of success. The other one, no success. So you can either invest at 2.4 lakh or do not invest. If you invested at 2.4 lakh, there is again 50% chance of that being success and 50% chance of that being not. If it is successful, you need to invest how much? 20 lakh. Either invest 20, right? 20 lakh and gain perpetual income of 4 lakh per annum. 4 lakh per annum. PV of perpetual income is cash flow by PV percentage. 4 lakh by 10 percentage, that is 40 lakh. So gain 4 lakh per annum, that is 40 lakh in PV. Therefore NPV is 40 lakh minus 20 lakh, 20 lakh. Or else don't invest. If you didn't invest anything, your NPV would be nil, because there's no PV of cash inflow and no PV of cash outflow at this point. So if there is no success on it, there are again two possibilities for you. Either invest or rather don't invest. How much? 12 lakh, gain 4 lakh 1 lakh per annum per picture. Again, 1 lakh by 10 percentage, 1 lakh by 10% would be 10 lakh. NPV inflow outflow 12 lakh, therefore minus 2 lakh. Are you stupid to invest 12 lakh to gain NPV of 2 lakh? No, right? So gain 1 lakh per annum, NPV 0, because you'll be not investing at all. Do not invest. Again, NPV 0. You understood it? There are, okay, let's say this is point A, or else this is point C, this is point D, this is point B, this is point A. So there is 50% chance at C to earn 40 lakh, and there is 50% chance at C uh, to earn 0. So NPV 20 lakh, 50% chance, NPV 0, 50% chance. So net chance here is 10 lakh. Again here 0. So NPV at B 10 lakh into here again 10 lakh. In fact, I've written it way much better for you. So if at point A there is a test, you need to incur an outflow of 2.4 lakh, or there's no test. So point B, if it succeeds, then you need to invest another 20 lakh, NPV in 20 lakh. If you do not invest, then NPV is 0. Again, there's a 50% chance of success, and there's a 50% chance of not. So you need to again invest 12 lakh and 1 lakh perpetual income. Therefore, NPV is 2 lakh. If you do not invest, NPV is 0. So at point C, what is a NPV? 20 lakh. At point D, NPV is minus 2 lakh. So you will be not investing. So let's consider NPV to be 0. At point B, since here at point C NPV is 20 into 50 percentage, and here it is NPV 0, 0 into 15 percentage. So at B, NPV is 10 lakh. At B, NPV is 10 lakh, because NPV at C into probability 20 lakh into 50, NPV at D into probability 0 into 50. Look at working out 2 to understand why it is 0 and not minus 2 lakh. The same thing, why will you invest? Since NPV is negative, it's better not to invest here and keep the NPV as 0, because no cash inflow nor outflow as a company won't invest in this project. So at a point B, at C it is 20 lakh, so therefore invest. At D it is minus 2 lakh, so do not invest. At B, these into probability plus these into probability 10 lakh, therefore you can invest. At point A, in the sense is a starting point, so you can either invest minus 2.4 lakh at A and reap 10 lakh at the point B, or you cannot invest minus 2.4 lakh and lose 10 lakh. So that would be better for you to invest minus 2.4 lakh and earn 10 lakh at B. So preferred choices: invest at A and earn 10 lakh at B. So with this, we completed from a scratch, with majority of a question carrying the importance, and rest of all the things you can manage it easily. And if in case there is any other questions that you people wish to make that be solved, then please do mention that in a comment, and I would be and that would be awesome experience for me to let the feedback be given by you people. So do like, share, subscribe, and comment about your feedback on this. If at all there is something that I need to improve, and if at all there is everything that I need to improve, and then I'd be so glad taking all these inputs from you people. And not just with these FM, in fact not just with these advanced capital budgeting, we'll be making revision videos on all the other chapters as well. And in fact, once we're done with the session, I mean with the revision video, or with the with the complete I personally don't feel this to be a revision video, because in my opinion, I just explained you everything from a scratch. And yeah, I was way too far at some things, because that was way too not necessary to waste both of our times. And yep, and once we're done with the session of each and every videos of these chapters, I'll be asking you people to comment down all the questions that you want me to solve, and I'll be taking responsibility of doing it as well. And not just for advanced I mean, not just for AFM. I'll be starting classes for DT and then FR completely free. You can watch that on YouTube. So that would be great and helpful if at all you people support me, because making all these notes, sitting here explaining you, and all this equipment and things stuff, that not it's not that easy to make it. I mean, it's not how we are seeing these presently is. It takes so much of effort of making entirely the video that's presently running in your monitor. So I hope you people, considering all these efforts of input, a like will be put by you people. A comment for the feedback and things that I need to improve would be put by you people, and subscription will always be done by you people. And the more the love that you people show, the more the energy that I'll be getting in making much more in-depth and revisionary videos on this. And yet again, I'll be not calling it a revisionary videos. I'll be calling it to be classes. Yeah. So the more love that you people show, the more energy and enthusiasm that I'd be gaining. The let's make it plausible. And yeah, I hope you people will do it. And in fact, share this with your friends, with your juniors, with your seniors, whosoever, with who. In fact, in my opinion, you can just skip all this. I mean, there is a myth that the final coaching is way too expensive, but for the fact it is not. You get majority of all these things covered in YouTube itself. So uh, I'll I'll be taking AFM, DT, and FR for free, including a question solving part. But provided you'll be letting me know what are the questions that are to be solved. So I'll take a leave then. Hope you people enjoyed the session, and to all the newbies, I hope you are taking these bundles and plethora of the knowledge on advanced capital budgeting. And yeah, that's it. Hope my and since it's my first my very first ever recording, I hope this went way too good. Unless you people mention otherwise, I assume that to be same. And I enjoyed it coming here, mingling with you people. So I hope the same with you. Hope you enjoyed. And then adios, mate, for the time being. Alright then, take care, mate. See you on the other side.